coaches at the Cash Compound, helping you crack the code to cash flow this Thursday afternoon, getting started with a little live Ask Me Anything. So I want to shout out to our YouTube audience that is all over the world. We got 4,500 plus subscribers at this point. All want to get better financially, learn the secrets of the wealthy, get into this infinite banking idea. And so we welcome you this Thursday, Eastern Time, 3:30. Robert, say hey to everybody.
Hey, what's up, man? I'm sorry about that. I'm over here trying to get set up. How are you guys doing?
Me too, though. Me too.
On the YouTube channel out there. I'm super excited. Me and Jonah got an episode that should be coming out maybe this Friday or soon here. So I'm definitely excited about that. The YouTube channel been growing. I know a lot of people learning on there. So
Yep. I mean, it's the second biggest, largest search engine out there. You know, we got Google. And then Google owns YouTube, but that's the number 2 place to search. Now, the number 1 place I've heard that Gen Z searches is TikTok. They search on TikTok. Yeah. But overall, across the entire world, we're probably talking Gen Z America as well. But I don't know if Gen Z India uses TikTok or not. I don't know. But welcome everybody. Jane, good afternoon. Hopefully you can see and hear us, Jane. Out there, we got Jesse, we got Jane, we got the YouTube audience here. We got Facebook coming up over here for our friends on Robert's personal, I assume, personal profile.
Yeah.
Cool.
Yep.
We're going to walk and talk you through a few things. Now, Robert, I didn't get, since you were double booked, you're a busy coach, had a lot going on today.
Yes, sir.
I have some slides that I prepared, just got done, fresh off the presses, that we can go into as a teaching topic today. I needed to build them and make them anyway, so now you know. We're going to look at my slides because we didn't get to your slides.
Cool.
So we'll get there momentarily, but looks like we're going to have a small family event here, but we do have new content. So welcome, Jesse. Welcome, Jane. Jane, can you hear us? Can you see us? Let us know. Maybe a thumbs up out there. I don't know if we can hear you, Miss Jane, Mr. Jesse, right now, but you can utilize the chat to talk with us anytime. You can. Yes. Okay. Wonderful.
Got it.
Wonderful. Well, if you can, Jane, we're going to have Robert. Why don't you say hey to your Facebook family here in a second? But Jane, could you tell us in the chat, or just in case I can hear you? All right. Got somebody else coming in. Jane, would you mind telling us maybe in the chat? I don't think I can hear you. I apologize. Policy. Give us a status. Are you an infinite banker out there? Or are you just dipping your toe in, see if this is the right thing for you? I think she is typing right now. All right, Robert.
So if you guys are tuning in on Facebook, we are talking about how you can become your own bank. All right, here's the book here, actually. So we're talking about the infinite banking concept. All right, and here's a book by R. Nelson Nash. And so we're helping some individuals here on a call who either already have seen some of our content and I have a policy, or they're thinking about becoming their own bank. So the individuals we're talking to have probably a little bit more experience or education around the topic, but it's going to be definitely some beginner questions. So if you're there, you want to stay tuned so you can get.
So if you've got
answers.
Beginner questions, ask them. This is the place for that, and we're probably expanding our community into a place where more and more people are going to be joining us on these live events that are really beginners. I think more and more people are introducing this idea and these links to their family and friends, so you may not have seen anything about us. So let me back up and give you a little bit of the big picture and the mission. We are here to crack the code to cash flow. And what that means is we're going to utilize guaranteed and growing products out there for places to store our money, store our wealth, store our income, so we don't have to use it, lose it, or abuse it. We can always be growing and cash flowing, okay? So we want to use it in a powerful and strategic environment. So we're going to eliminate taxes. We're going to be able to spend money twice. We're going to be able to recapture dollars that leave our family, all sorts of crazy things like that, but we're going to walk and talk you through it. If you could, ladies and gentlemen, on our Zoom channel right now, what's up, Antonio? What's up, Jane? If you would, throw into the chat where you are zooming in from. If you're able to get to that chat there, put it in. We're in Greenville, South Carolina, on the East Coast here, northwest corner of South Carolina. We've got our YouTube family out there. We've got our TikTok family. We got our Facebook family over here. Welcome to everyone. Okay, so All right, what's up, Kevin? What's up, Kevin? All right. Good to hear from you, man. Good to see you out there. We gotta do a whole family reunion for you with all your people. So you hit me up. You let me know. Sometimes I think you hit up me in Dayton, Ohio. Sometimes I think you hit up Jonah sometimes and me sometimes or whatever. But hey, we're ready to do a private family reunion for you if you want. What's up, Gavin? Welcome back this week. Gavin, thanks for coming back. To our TikTok audience, thank you. Welcome. Follow us right here if you want to learn more about the secrets of the save and spend system. Okay, we got North Carolina here. Now, I know it's kind of hard on your phones, and I think Jane and Antonio both might be on their phones. So, oh, there we go, Jane. Very good. All right, Jane has got our first question. It isn't Ask Me Anything, so I'm going to pose this question to Robert.
All right.
And what you can do is wherever you are on your streaming channels or YouTube or on Zoom, type in the chat. We got to look a couple places here, but we're going to answer your questions about doing this. Like you doing it, you actually saving and spending money at the exact same time. I'm going to show you a little bit later my latest policy. It's the 1-year anniversary today.
Oh,
That's why
yeah,
that's why I got some slides ready for you. So we're going to show you that a little bit here. Robert's going to answer your questions. You can get a free consultation after this call. We'll put that chat in a couple of places for you. So if you are on our live streams, you probably can click a link in the bio. If you're on Zoom, we'll drop it in the chat for you here in a minute, okay? So here's the first question here coming in for our friend Jane. She says she's got a book.
All right.
All right, she's reading it. She's got a few questions about policies. When building a policy, do you plan for contributions yearly, or do you plan to only contribute for a set period of time?
Yeah, it's an interesting question. So I would answer it in this way. So as far as like a contribution, we're making premium deposits, and we're going to consistently make those deposits, whether it's a monthly, quarterly, semi-annual, or annual frequency and method of paying, right? But the number is the same. So I know when I first came into the game, one thing you were saying, well, $1,000 a month is the same as $12,000 a year. There's the same number. It just might get paid differently. Another thing too is some individuals, depending on the type of plans and what you want to do with your strategy of wealth, there is such things as like a 10-year pay and so on and so forth, where you can pay into it for a set amount of time that you would like to pay into it. And then from there, you can just simply utilize the policy for banking. On any given scenario, I would definitely prefer to continuously pay into my policy, being that every time I put in more deposits, the death benefit is rising more, which then gives me more cash to spend. So unless I have some kind of, like, maybe I'm looking to retire or something like that, I would go with the method of continuously paying my policy. But there is other options, and that's why we customize policies for banking. Everybody's a little bit different. Everybody has something different that they might want to accomplish with their policies.
Love it. Thank you, Jane. So I will follow up with a little bit more than that. Plus, she gave us a little bit extra here from Pennsylvania. I don't know if I want to pay when I'm 80. I get it. Totally fine. Yeah. So number one, we do suggest we think long term. If you're looking in the book, Jane, you said you just got Nelson's book. Number one rule, think long term. Now, at the same time, you're probably not going to be working at your job anymore when you're 80, right? So you're like, I get it. Mm-hmm. So this is what I might help you understand. Number one, we can preset the policies to pay until you're 65 or pay until you're 70. That might be what you want to do. So I'll tell you that up front. But let me tell you why you might not want to. See, every dollar we put inside premium, cup number one, if you've seen us talk about the save and spend system, it's got the 3-cup setup in it. So if you've seen that, raise your hand, shout out there, thumbs up. Okay, the 3-cup setup. When we put dollars in premium, everything we ever put in will continuously compound. So that means, Jane, when we go to get cash value in a separate cup, it's a separate pool of money, all of our dollars keep compounding. So let's say Jane looks like she might be 30 years old. I'm not sure. So Jane is 30 years old today, right? She perked up there.
She's
so
smiling.
I apologize, Jane, because it's probably 29. I apologize, Jane. It's not 30, it's 29. Okay. She says she wish. She says I wish. Okay, well, however old you are, it ain't my business today. The insurance company's going to ask, but it's not my business. Okay, let's say you're 30 today. You pay premiums each and every year. and you're 80. Now you've paid for 50 years. Makes sense, right? I'm doing the math
All
right?
right. Yeah.
Yeah. How'd you do in math in high school?
I was all right.
Okay.
I was all right.
Okay. So 30 to 50, you've put in premium, whatever number you and Robert were talking through. You set that premium. It goes in every year where all of those dollars are in. So let's say you did choose $10,000 per year. Round number, simple math for me. $10,000 each year, whether you paid it monthly or annually, but $10,000 each year for 50 years is how much money, Robert?
10,000 a year for 50 years.
Yes.
If I'm correct, was that $500,000?
$500,000. Is that right? You guys fact checking this man? So here's the
way
thing.
you said it, I'm like, man,
In year 51, Jane is now 81 years old. In year 51, Jane, hopefully you're still out there. You went black for a second, but I'm trying to make sure you understand my question. I see you in there. You tell your kids you're 32. I love it. Okay, so Jane has put in 10 for 50 years. In year 51, Jane is now 81. She puts in 10.
Mm-hmm.
But how much is compounding for her?
Everything she's put in prior to that is still there compounding.
Everything.
The money
So
never- the
Jane,
money
in
never
year
went anywhere.
50, when you decide to continue paying premium, Jane, they don't see $10,000. They see all of your dollars. So what's going to happen at that point is they're not going to give you a new level of cash value based on 10. They're giving you a new level of cash value based on 500,000. So that means you're going to give them 10. They're going to give you quite a bit more than 10. Immediately, cash value, liquid, income tax free. You give them 10, they give you way more than 10, ready to roll, income tax free at your pleasure. So my question is, are you sure you want to stop?
Yeah, it's gonna keep getting better. I think to kind of add to what you were saying too is a lot of people. So I didn't understand this when I first came into the game. Is that you were telling me, you like, yeah, Rob. So cash value has to rise to meet the death benefit.
Yes, it's a contractual guarantee. Your cash value must meet the death benefit at maturity.
So if I put in, let's say, going with the example that you already gave, let's say up to that point I had put in $500,000. Being that they have to take my money, grow it, and turn it into more money, I know my death benefit is a lot more than just the $500,000 I put in, right?
Mm-hmm.
So from there, if I know my cash value also has to go up and meet that amount, I have a lot of liquidity. I have a lot of money that I can spend from.
A whole bunch.
And so
Whole bunch.
if you're thinking about retirement, if you're thinking about stuff like that, like your premium, what you put in at that later year compared to what you could actually take out, technically I could afford to pay my premium using my cash value.
You're going to see it on paper, and once you see it, you believe it because it's guaranteed numbers. But Jane, hopefully that answered some questions for you. Okay, so you let us know if that made sense. Every dollar you put in, let's say you paid $10,000 for 50 years, $500,000 is in your 51st year of the policy, you're 81, you put in 10, they're going to give you a new amount based on $500,000, not 10. Exactly. It's going to be a great day for you. So let us know if that was helpful out there. Shout out to Anchorage, Alaska, my man Antonio. Antonio, do you have an infinite banking policy yet? Second point that I want to say is give a shout out to my uncle. I got an uncle up there in Anchorage, and my aunt, she is a Chupik. She's a Chupik. You heard of the Yupiks, right? Yes. Okay. She's a Chupik. It's even a smaller tribe. These are
Native American tribe?
Native American Alaskan. Yes.
Okay.
The old term we may have used back in the day would have been Eskimo. It was Native American Alaskan. Yes, she's Chupik. So yeah, shout out. I've been up there.
Antonio is inside of underwriting right now, if I'm not mistaken. So,
oh, Antonio, you started?
He's going through the process.
Started the process. Love it, ladies and gentlemen. Remember, if you want a free cash consultation around this concept, Robert is taking calls this week. Okay, so we're gonna drop the link in the Zoom chat. Everybody else, click the link in the bio if you're here on our TikTok. Our friends out there doing their thing on YouTube. I don't know where you click, to be honest, but maybe underneath this video. But anyway, we've got free consultations for everybody who wants to get questions answered. No pressure, but it is free. Let me get my questions answered. I might want to start this process, or hey, like the Higgins family, hey, we need to get a little more spread throughout all the cousins. Okay. Appreciate you saying and giving us stuff. You guys, would you like to see my slides? Ladies and gentlemen, it is an anniversary for me. Happy anniversary, ladies and gentlemen. September 7th, 22, I started my last policy. I'm starting another one now, so it won't be my baby policy forever, but it is my baby's and my baby policy. My baby is 15 months old, and I want to talk about his policy. Let's talk about why we started, how we started, and how it's grown. You guys want to see that? Let's get into it, because today is the day. Okay, if I do this, I think you guys can see my screen. Yes, you see the cracking. Now, I apologize. For the last several minutes, let me stop sharing for a second. Okay, Antonio and Jane, we apologize. Are you guys seeing us now, but you weren't seeing us a second ago? Okay.
They were looking at the
gotcha.
screen.
Okay, very good. Sorry, that was all the intro, but now I'm going to share, and we're going to walk and talk people through who can't see it yet. But remember to follow us on the YouTube channel, everybody, and if you register for this, we can get you the recording so you can see our screen. But don't worry, I will walk and talk you through each piece of the pie, and you can ask questions the whole time. Okay, so what we're going to do here is we're going to show some of us on the Zoom experience here. We'd love to see you on Zoom if you want to see this stuff week to week. What we're going to do here, I'm going to do this one. So we're going to share with you what we like to call over here father figures. Okay, father figures. Ladies and gentlemen, let me show you a little bit about and help you understand what's going on. We want the dollars that come into our family to always go up, and therefore we're going to make sure we start these banking policy contract systems, infinite banking, cash flow banking, privatized banking. We're going to start them on everybody in the family. Okay, now, Robert,
Yes, man.
when are you announcing that you guys are having some kids? That's what I want to know, because I have kids. I have 4 children, but when are you announcing?
I don't know, man. I've been thinking about it, but I don't know if I want to have kids right now. I got to do some more traveling, but even when I do have children, I'm doing the same exact thing you did.
There you go. You're going to take them with you.
Yeah. I'm thinking about it 500, like when you gave the example of 50 years of compounding the same number. I'm just thinking about, like, dang, most people won't get 50 years unless they get started earlier in their life.
You're going to have to get started. Well, it depends on how long you live, of course, right? But if you don't start by 30-ish, 40-ish, you may not make it 50 years. And there's no guarantees in that part of the system. But there's always guarantees in your contract that no matter how long you live, there's still going to be more dollars in there. So we're going over here. If you're on our Zoom channel, you see this. Let me give you a couple of ideas. When we're starting the infinite banking concept, and we're going to start it on ourselves in most cases.
Correct.
Ourselves, the people who are interested in this, might be the breadwinner. Okay, I'm going to call it the breadwinner. That could be male, female, he, she, they, them, whoever. But you're thinking about starting it on yourself. Why is that? Well, number one, in the world of insurance, we're utilizing whole life insurance. The insurance company's got to know your economic value. So we need to start with somebody in the household who's probably going out there working, killing it, bringing home the bacon.
Correct.
Okay, so we're going to start with that person. So in my family, we started with me. Then I put breadwinner and +1. You can see, by the way, it's up there, Robert, just in case.
Oh, I don't know why I'm still looking around.
Yeah, well, I'm just, we got all sorts of things. We got a couple, we're live in 10 places here. But, okay, so breadwinner +1. So that's the misses. That's the tier 1 level of people we're going to start on. My wife is a homemaker. We got 4 kids at home, but when we started, there were 2 kids at the house, babies, basically. She and he. There were 4 of us. Now, we've added 2 kids since then, and those are tier 2 people, the children. Now, we're going to compound and grow every dollar we ever get in this thing. So wouldn't it have been nice, Antonio, if mom and dad already started this system on you back in the day? Wouldn't it have been nice? Every dollar would have already been compounding and growing, and we can't get those years back. So what I'm going to do, the person who is able with the means to put the dollars on my kids, I'm going to start it so we can get this thing going and cash flowing today. So that's tier 2, our kids. It's going to be able to have provide a guarantee on them having coverage. God forbid that they get to a place where they're not insurable because of health or something else later on in life. We've got the means to put dollars in. Obviously, we should have started back in the day, But I didn't have no money back in 84. I was a baby. So
Yeah.
who's supposed to start it, right? Who's supposed to start it? Well, my folks. So we're those people who can start. And here's another thing. How many of you were able to have lots of conversations, healthy conversations about growing money, creating value in the world when you were coming up in your house? Were those normal conversations for y'all? Jesse says no. Antonio says no. Well, we can start that conversation now with our children. Jesse is one of our coaches here at the Cash Compound. He has got a great slide deck, a live event. You've got to make sure you hit him up for the next one. If he's your coach, have him share that with you. Maybe you need to expand your system with your family members. He's got a great deck, a keynote on exactly what I'm talking about. How and why he has expanded his system for his family. Well, we can start that conversation now, even when your kids are little, because we've created a banking system for them. Tier 3, we won't get in that today. Those are your business partners.
Hey, you looking out?
Well, I'm just saying.
Right.
Well, I'm just saying. My business partners out. You can also own insurance on them. Why not have banking policies? And obviously, if your business partners go out of commission and meet their maker, then how does the business continue, right? So that death benefit can keep you in business, sometimes keep you out of business with their spouses, because maybe you don't want to be in business with their spouses, right? If they're pass on, or maybe their spouse does not want to be in business with you, so you need to be able to buy them out, right? And pay off their family. Does that make sense, everybody? All right, so let's go. And let's remember the 3-cup setup. I'll go through it kind of fast. I think everybody here is on the inside so far, but if we get those specific questions, we'll answer them. Get us those questions anytime. But, well, Robert, this part is generic, and you know it better than anybody, man. So why don't you tell us what's going on here in the 3-cup setup?
Yeah, so the 3-cup setup, and we always, normally we show it with our physical cups here, but looking on the screen, you'll see, I'm going to go from the far left from how I'm viewing it, premium deposits, okay? So our money goes into our policy, and then from there, it's growing with guaranteed interest from the insurance company. Next is going to that growth. What do we call that growth? We call that the death benefit. All right. The death benefit, really simply put, if anything were to happen to you at any point in time, it's a whole life contract. Does not matter when or where it happens. They're going to cover your death and pay your family the large lump sum of money, right? The cash value is how much of that lump sum that we can use at the given time in our lives. Okay. So year 1, year 2, year 3, year 4, every year, the cash value number is increasing. So the amount that we can use of our death benefit is increasing every single year. And so when we're taking from cash value, notice with them being different cups, it does not affect the premium deposits that we originally put into the policy. So all the money that we put in continues to grow and compound with interest. Meanwhile, we can still spend money to do and take care of the things that we either need or want.
All right. Love it, Robert. Perfect. Why don't we give them a visual on that? So let's put some money in the game, shall we? Tell us.
All right. Pay the premiums. Got you.
Keep talking us through it. I just want to make sure you knew that it was
we
coming.
paid our premiums. As you see, I like the color reference, and most importantly, you see what happened. It got us a larger number. The blue cup is obviously more full, right? So our little bit of money turned into a lot of money. Okay, let's see what's going to happen next. Now we're going to get a sum, a stated value of how much we could spend, and that's going to be the cash value. So as you see, our cash value now has there's some liquid inside of that cup as well, which means that we have some liquidity to go out and spend some money and take care of some things we might need to take care of.
All right, very good. So, ladies and gentlemen, cash value is now going to be utilized from Cup 2. Robert was saying that. He didn't know the visuals were coming. So remind us, can we use this money? And why don't we use some?
Yeah, absolutely. You can use the money to pay down. I would always tell people to start with on a more personal financial level. Mm-hmm. Everybody said, I want to go make an investment. That's a great thing, but I think kind of getting some monkeys off your back, so to speak, hypothetically helps you run a little faster. So if you can stop so much money from leaving your household and you can keep more of your income, you already are wealthy.
I like that. Right.
And then
what if we could just keep what we already make?
Exactly.
And what we already have?
If we don't fix that, then I forget the law. You guys used to talk about it all the time. is as you become more wealthier, your
Parkinson's.
Parkinson's
Parkinson's
right?
law.
So your expenses are expanding to meet what you're making, so you're
Yep.
not actually getting ahead in life.
So let me ask you,
yeah.
somebody out there like that. How many of you have gotten to the place where you? Oh, I'm sorry. There's Robert been talking. I forgot to show you all over there. Okay. How many of you have made more money out there at any given time in your job life in the past, and it didn't seem like you got a raise because almost immediately you expanded what you were spending, right? Once a luxury once, how does it go? Nelson Nash says it. Jesse could correct me. I'm sure he can out there. Luxury once enjoyed cannot be
It becomes a necessity.
necessity. Yes, becomes a necessity.
Yeah.
Somebody, y'all know what I'm saying. Just don't worry about quoting that exactly. Very good. Okay, so why don't we take a loan from Cash Value here and maybe get a monkey offer back? Maybe what if you could save your money and spend theirs on your debts?
Yeah, so you could then, and I always tell people, think about reconsolidation. Reconsolidation companies aren't out there for any reason. You could go take a loan from your policy, pay down towards your car note or credit cards, whatever the case is. You have now reduced that debt, and you could have the opportunity to pay yourself back where you keep all the money you pay back. If you had to pay that same debt, whether it's a car note, house note, credit card bill, you would have lost the money plus interest to that particular company versus having the opportunity to get that money back inside of your system. And that's exactly, to me, that's what infinite banking and becoming your own banker is about. How much can you keep? And then once you figure that part of the formula out, like right now, like I feel like that's the stages I'm in. Oh, I need to keep more. I got the investing down and so on and so forth. That's always going to be there.
Right.
But if I can get this part down, the foundation, then I can go on and expand and take more risks and so on and so forth. But first, you got to start with the basis of I need a safe foundational plan and strategy of my wealth where I can just get back more of the money that I already make.
Love it. All right, so we're going to do whatever it is you do, maybe pay off debt, by taking dollars from the insurance company, Cash Value, Cup 2, Green Cup. And when we do that, it temporarily reduces the death benefit. Remember, Cash Value is just the net today amount of the future death benefit. They must pay. They have to pay. Okay, and so let's expand here. Now, when we repay loans, if and when we do, which we suggest, you should be a good, honest banker. When we put dollars back in, it replenishes Cup 2, where we took it from, which automatically increases that death benefit back to its, let's say, original state because we repaid all of our loans.
Mm-hmm.
And now we're at our annual place, dividends. Ladies and gentlemen, we're going to show you that right now. Let me jump into that let me just advance some of these slides, shall we? We're going to advance some of these slides, and I want to show you actually, I'm going to need that back up on my second screen there. All right. Will is doing our production right here because I want to show you what happens when we get to our first anniversary. Ladies and gentlemen, let me introduce you to Tier 2, the Tier 2 people in my house right here, the Do Generation 2. Those are my kids right there, 1, 2, 3, 4. She's the oldest. And 15 months ago, we had baby Jesse. There he is. Obvious which one he is. And we wanted to get a policy going for him, not just on him, but for him, so he can use these dollars. Yes? All right, so there he is right there. And now, Robert, when I called the insurance company, I said, hey, I want a policy on this baby. They said, well, we want to know about policies on the other kids. They didn't even say yes. They asked me questions. What about the other kids? Well, now, why would they do that? Why would they care? Why wouldn't they just say, like, sure?
You know what's crazy? I finally looked into that whole John Benet Ramsey thing. And you know they solved that case, right?
Did they solve the case?
Yeah, the end of last year, they solved the case.
Did they? Then everybody who's older than Antonio knows they never solved that case.
Yeah, that's what they said. They said they found a guy. They found the guy that supposedly did it.
They didn't find the guy.
And he confessed to it or whatever. But
okay, maybe
either way it goes is, long story short is that the reason why the insurance company wants to know about the coverage on other children inside your household is, of course, no kind of favoritism things being played out here, and more importantly is they need something. They need to be able to evaluate the coverage. So then they might have even asked you what inside the next thing was, well, how much coverage do you got on yourself, right?
100%, right?
Because we need to be able to value. Your child doesn't have an economic value per se. They don't have a,
without you.
Yeah,
right?
without you.
Without
Right?
you, they don't have
they
an
don't have a
economic value.
job. And then more importantly is, well, if we insured, we need to make sure we insure all of the children in the household if you want to start out by insuring one of the kids. And so that's going into the whole JonBenet Ramsey or whatever, only one child had insurance. Since then, insurance companies realized, well, that could be a problem. So let's make sure everybody.
Now, if only one kid, if only she had insurance and not her brother, I didn't even know that. I just know that everybody understands the JonBenet Ramsey debacle of the entire decade of the 90s and someone being able to cash in on that. So that's the reason. Hopefully you guys got it. His older siblings already had life insurance, and they had to ask, well, this new kid can only have as much insurance, Cup 3, only as much payout as the other kids. So that means that we ended up starting a policy for about $100 a month. This is the smallest style policy we do around here, and we can only do them on children at this level of contract premium. I know this is too small for you, but those of you who are out there not on our Zoom, let me tell you what we decided to do. $100 a month, $1,200 a year. If you're looking at it now, we're going to make it bigger for you. It's going to be $1,200 in contract premium. That is cup number 1. You guys got it? The money we put in. Now, the insurance company has a unilateral deal with us, or more likely, we have a unilateral deal with them. They got to do every other number on this paper, as long as my boy's alive, and we give him $1,200. So we started doing that. Let me actually introduce you to what we bought Cup 3, death benefit. Our dollars today, 1 year ago today, bought $146,000 of death benefit. God forbid my baby dies. I'm going to collect those dollars. Mom is going to collect those dollars because we got to put this baby in the ground and we're going to cry for a while. A long time, right? I'm going to cry until I'm gone. But hopefully he outlives me, way outlives me. We started this policy with PUA cash value. If you want to look at that particular line on year 1, that is what is liquid. Cup 2, green cup.
$465.
Robert got it. $465. You guys see it? Yeah, I'm the same age as Jane out here. I'm having a hard time seeing stuff. Okay, you guys got it? Any questions, concerns about that? Oh, I think there's somebody, who's been trying to get in for a minute or two. I don't know how long they've been waiting. Oh, I've been looking. Okay. Welcome somebody to our Zoom channel. And remember, if you are out there watching us on YouTube, you can put comments, questions, and concerns in the Slack, in the chat. I keep saying Slack. I use every tool out there, Slack, Trello, WhatsApp, GroupMe, right? Everything. Wherever you are, give us a little shout if you need questions answered. Okay, so let's take a look at it again. So we decided to put in $1,200 per year. If you decided to do that monthly, Jane, it's $100 a month. Everybody understand that, right? 12 months in a year?
Gotcha.
Okay, cool. Doesn't matter to us. Okay, we engineered this policy on purpose to have cash value. This particular company splits base cash value. That's high-level learning. You guys don't need to know all that. With the PUA cash value in 2 different columns. So you can see one column says 0 of cash values available so far, and the other one says 465 so far. Got it?
So we just add those columns together.
Just add them together as you move down.
Yeah, and the total is 465 for that year.
And it's a cumulative total each and every year. Now, I'm putting in $1,200 of premium. Now, I want to show you on the next slide. We'll make it big for you, but let me introduce you to the beginning of me putting in extra dollars. Over the course of the year, the insurance company says, actually, there's room to buy more insurance, paid up additions, if you'd like to put extra dollars in Cup 1. So we started to do that. Hopefully you can see that we started to put in, and right away, I put in an extra $400. Robert, can you see that?
Yeah, I got you.
$1,600 went in to start off. But I didn't stop there. Over the course of this year, all the way up through last week, each and every month, I put in just as much as I possibly could, and I had sitting around to create a larger pool of growing dollars. Okay?
Yeah, the difference is here. Okay, so when you put in that extra $400, it's not just the 1,200 that you would contractually pay. It went from 465 to $852 inside of cash value that was accessible inside of year one.
Yes. You guys see how we're doing this now. More and extra dollars are going in cup one. Okay, I can see some nods from my our friend. The only people we can see are the ones on Zoom. We can see you. Everybody else out there, TikTok and stuff. Just gotta take our word for it. So, okay, so I put in some extra dollars. How much more did I put in? Great question, Jane. I've got it on the slide. Now, in the initial month, I put in 400 extra dollars. You remember my premium was 100 a month or 1,200 per year. In the slide we're looking at now on the Zoom for our family out there, $1,600 actually went in really early. Almost immediately, I actually put in 400 extra dollars. I called the company and said, hey, will extra dollars fit without becoming taxable in this policy? Will cash value become taxable if I put in an extra 400? They said, nope, go for it. So I did. That immediately gave me more death benefit. Robert, do you remember we were at 146 in death benefit?
Yeah,
What are we at now?
Yeah, we're at $158,800.
All right, so our death benefit went up. More premium bought more benefit. More cash value available immediately. You guys see it? But it didn't stop there. But wait, there's more. As I was saying, we continued to put more and more dollars in over the course of the whole year, over the course of the entire first year. So each and every month, I kept calling and asking, how much more can I get in on this policy? They gave me limits per month, but each month I just kept doing it. I already paid $1,200. I paid that annually. Paid $400 in month one. I paid another chunk in month two. I paid another chunk in month three. And all of those dollars are going to continue to compound and grow for my baby's whole life. Robert, tell us, how many years did you miss out on because your mom didn't start that for you?
23 years. Yeah, the thing about it, man, is like I'm just sitting here listening to it. I'm like, man, I need to be a do child. Because if you think about it, like when by the time your child is old enough to actually spend money, and there's like different little programs out there, right? You can do this, you can do that. What's the 529?
529 is that education plan.
Yeah,
but
right.
That's an investment plan.
Yeah, exactly, right. Where you make some kind of investment. Yeah. It's like if you can have guaranteed growth. You don't have to do anything but pay into it. It's guaranteed to go up. There's no market volatility or anything like that attached to it. You're securing a financial future for your child in the best times of their lives. So when they need it the most, by the time they're actually spending money, they're full-grown adults. They will have a stockpile, if you will. They'll have cash to spend. They'll have a reserve to use to be able to do some of the things they want to do, whether it's buy a car, try to finance going to college, whatever the case is.
Whatever they want to do.
Whatever they want to do, they already have that. So you give them that start. More importantly is now that they're full-grown adults and they're inside the point of their lives where they might be bringing in some income. My first job was Zaxby's. Maybe they're 16 or whatever the case is, and they just started working. And they're not, they're still in the house or whatever. But the case is that they have the opportunity to take money from their income, put into their own policies, and use it for banking. Even though they're younger, they still have things they might want: birthday presents, bikes, clothes, shoes, whatever the case is. The policies don't have to wait to get used.
They don't.
So just like you're doing banking right now,
right.
you could be literally using your child's policy for banking, buying them Christmas presents or paying off some things or whatever the case is that you want to do with that money, paying it back plus more, and even making them even wealthier by the time that they actually become of age. And you have the ability to also sign these policies over to them, which is why you want to be teaching them the methods of being their own banker. And what better time to teach them, just like how you're doing your children now. I love the episode. It was crazy. He had me rolling with the gumballs.
My 3-year-old son, we talked about his policy a little bit earlier for Father's Day. So I brought him in the studio. My 15-month-old, I try to teach him money, like Robert says. But he ain't listening.
Yeah,
all he's doing is crying.
Exactly.
Right?
So but think about they'll have those lessons and they'll know what to do. So whereas when I was coming up, it was like it was the go-to. You got to go get a credit card. You want to build credit. You got to go take a loan from the bank if you want to do this, that, and the third. they're only going to honestly.
Just keep your credit score high.
Exactly, right?
That's what moms were telling us.
That's all we knew, right?
That's all we
We
knew.
were just working to build credit. We weren't trying to build any wealth. And so I
Ooh.
think like right now is that they have a unique opportunity that by the time they're older, they're going to already understand what it is to be their own banker, and that's going to completely change the financial outcome of their lives compared to their peers who might not have had that same start. So
Love it.
it's awesome, man.
Very good. Okay. Well, with that in mind, what I just heard from Robert, I think one day he's going to be a great dad. He's going to be a great dad, at least financially. I don't know the rest of them, but I don't know what he's going to do or whatever. Don't let him look at screens, man, till they're like 4 or 5 years old. That screens will kill him these days. Okay. Jesse
Yeah.
knows what I'm talking about. Okay. Now, now, Will, our producer, you still over there? Okay, Will, let me get to, you've got my second screen, so I want to advance to my next slide here. And I might need you to, there we go. We might
Okay,
just zoom
gotcha,
out a
gotcha,
little
gotcha.
bit, and then I'll share it when you're ready. Okay, so I'm going to give you guys the update now. Today is the day, is anniversary day. And I'm excited. Why? Because anniversaries mean dividends. Robert, would you explain to us one quick second right here
Gotcha.
what dividends are, where they come from, why we get them on anniversary?
Yeah, really simply put is that we only use mutual companies. We don't use what's called stock-owned companies. So there's no shareholders on the other end of those dividends that they pay them to. We as policy holders and policy owners, we get dividends paid to us when the insurance company makes a profit. And so far, they've been very profitable for over, 150
this
years.
particular company that a lot of you probably will be utilizing if you work with us. We use this company a lot, but we are brokers. It's not about the company. It's about the type.
Yeah,
And that's what Robert is saying. It's about the type of company. This particular company has, I believe this is year 145 straight in a
Yeah.
row, back to back. Was that dude off of Schitt's Creek, right? How many things in a row consecutively back to back? That's how many years in a row they've paid dividends. All right, so we got that question coming up to us in YouTube in just 1 second, but go back to the policy. We'll keep the train rolling. We'll come to that one, and let me share with our audience out there. Ladies and gentlemen, the grand totals, everybody who cannot see it, write it down if you want. We're going to tell you what's up. I looked these numbers up just a few minutes ago. Ladies and gentlemen, there's my boy first off. If you're out there, there's my boy Jesse. He's in his James Dean phase right now. You see that hair, that tuft of hair. Okay. Hope he doesn't pass away in a car accident at like 25 years old, but maybe I'll still own the policy at that point, and I didn't give it to him, and I'll collect that damn benefit.
Yes,
All right,
man.
just making sure y'all understand. Cup number 1, premium. How much total did I get in? Not just $1,200. Robert, what's that grand total that I got in
Yeah,
this year?
$6,550.
I got in $65.50. Okay, all of those dollars are now banked.
And
They will
if you
compound
said
and
this
grow.
is the 1 year anniversary,
Today, September 7th.
you going crazy in that thing, man.
All right, hey, no more. Hey, pour no mo.
Yeah, that's
Po
that's
no
good.
mo.
That's
How
good.
many of you put that in the chat? Po no mo for the rest of your family. Okay, cup number 3. Originally $146,000 of death benefit we bought. Cup
Now-
number 3. What is it today?
Yeah, now it's now sitting at $192,138.
192, 138. This baby passes away. I'm gonna cry hard, but
With
And
$100 bills. Huh?
but I'll have a couple dollars to put him in the ground
Got you.
to start a little legacy for him, a little trust for him, a little memorial for him, or whatever, in his favorite playground where we like to play something, right?
Yeah, man.
He will continue to be an influence after he's gone because these dollars will pay out. At least these dollars will always pay out. He's going to die one day, and it's at least this amount. So now let's go to cup number 2. Cash value available today. We going to take a loan so he can go to Chick-fil-A. He's in Chick-fil-A right there. We going to buy him all the chicken he can eat. How much money do we have available?
$4,223.
Okay.
Is what's available
So far. So, Robert.
at that moment. Yes.
People are asking you day after day, hey, should I start policies on my kids? When should I start? What should I do? When you see these numbers on my anniversary day, big day in our house, well, how do you have a
I
conversation
tell
with them?
people now that if you're talking about becoming your own bank, and you need multiple branches to a bank because most banks have multiple branches. More importantly, is that there's no better time to start. If you're seeing it now and you're like, oh, this is really great. Well, think about the age that you're at. Imagine if you think that way now.
Right.
if you had the coherence to think that way at an earlier age, you probably would have did it for yourself, given the opportunity, right, and the funds. So I would tell anybody is get started earlier on, because infinite banking as a concept to me is a family banking system, or just having more than one policy in itself. So that's why I've grown my system up to be 5 policies. I don't have children yet, but when I do, I guess I'll have, 10, 15, however many policies. But either way it goes is just understanding that you have to expand on what you're doing. So think about kind of diving into this real quick. If everything chronologically goes the way it should, you've established generational wealth, not just for your children actually, but for your grandchildren that you may or may not meet, right?
Right.
And so that means that we're talking about at least 2 generations of success. And now from there, they know how to be their own bankers, and the next generation understand that it's you've kind of greased it and got the wheels turning, man. They just got to keep it going from that point forward.
Love it. Okay, well, you've got some questions and concerns and comments out there. We're coming to it. We're going to go to our YouTube audience out there in just 1 second. Our producer may have stepped out because it's kind of hard for us to see where we're sitting. So I'm going to go over here and say something to our folks who are hanging out on the Zoom still. They're going to get a little extra love, but don't worry, YouTube, we coming for you. Jane says, I wish I knew about this when my kids were born. I bought 3 policies called 20 Pay Life. I think it's similar to something like Gerber. Yes, so after 20 years, you can't pay any more premiums. Okay, if you don't have any riders on there, because there are riders that come with bells and whistles that come on certain policies at certain companies, but after 20 years, you can't put in more. Is that bad? No. You've got them guaranteed a death benefit for when they die, right? This is a whole life insurance policy, Jane. Ain't nothing wrong with that. We just want to emphasize and engineer them on purpose for banking. That's what we do. So there's nothing wrong with what you got. Hopefully it's with a reputable company. They're going to be here one day to fulfill those promises in 100 years, right? We're not wishing our kids die today or tomorrow, but those will pay out. Now, cash value should grow in a whole life policy, even of that kind that you can borrow against, Jane. So we'll still help you navigate that as you get policies with us or as we teach you and coach you through your system. But yeah, we can help you understand what you already have, which you probably didn't buy for cash value at all. Probably didn't even do it. Didn't even know it was there. But if it is there, hey, let's go in there and use it some. Okay, appreciate all of our friends and family out there hanging out with us on the Cash Compound TikTok channel. On YouTube, it's, I believe it's youtube.com/The Banking Bros. And we're on Robert's Facebook right here. Appreciate, shout out to everybody. Will, when you get a chance, we'll take a look at our YouTube comments right here. But, the last link that I dropped, ladies and gentlemen, is our Facebook group. We got an educational and fun Facebook group. I put stuff in there about my baby's policy today. You can go get the replay on that by going and checking out that Facebook group. It's called Infinite Bankers, and we want you to be a part of that and invite your friends in there. So you'll notice that if you're looking at my screen on Zoom that I don't have the first-year dividends. Well, today's the big day. It is the anniversary. I just paid my annual premium. $6,500 won't fit in this year. In the first year, there's a lot of extra room. But $1,200, my premium, went in. So it was a holiday weekend, so I think, I don't know, went in yesterday or something like that. They couldn't take the money on Monday. Y'all know how that works, right? But $1,200, my regular contracted premium, Cup 1, goes in, but that new $1,200 goes on top of all the money that was already in there.
Yeah, previously deposited.
All right, so all those dollars are going to compound and grow. Be ready to cash flow for my baby anytime he needs it. Right now, he's not very savvy at business. He keeps us up at night, but he ain't savvy at business. One of these days, I'm going to introduce him. Hey, man, we're going to go and do this business deal together. Jesse taught me this. Would you like to go in business with me? Take a loan from your $4,200. We're going to do some business. I'm going to get you your interest, and I'm going to put it back in your system to expand it. And if I can get him to say yes, then we're going to go into business together. So maybe I'll loan some of this money to Robert. Robert, you need a couple dollars?
I've been waiting. I've been in line for a minute now. I'm waiting on my soup. Yeah.
Very good. All right. You got, what am I doing here? Oh, it popped over there, didn't it? Okay. Let me let somebody in. My multiple screens is doing funky things to us.
Oh, I see what it did. It put it up.
Yeah, it put it over there. But don't worry, I'll just stop it, and that should help us. Okay, we're going to stop it right here. We'll come back over on this side. There we go. Okay, so I'm not sharing anymore. But yes, okay, we're going out to our family over there in YouTube.
All right.
Robert, here's one for you. Okay, Maximelt says they convert to individual coverage at what age? I know what they're asking. I don't know if you do. So this policy, the type of policies for banking are only on individuals. My baby's policy is not on me at all. Okay, so it is individually covering him. It's not a rider on me at all. It's a separate policy, separate from mine that we have on him. So all the numbers I gave you and all this has nothing to do with even if I keep my policies. Let's say I'm cray out here and I get rid of my policies. I surrender them, stop paying them. His policy still exists. It's a separate policy.
Yeah,
Hopefully that's a helpful thing.
That's the answer I would have gave.
Okay.
Is every policy separate from each
Yeah,
other.
these types of policies are separate. Very rarely are we doing any type of joint survivor additional for the kid. That's not these style of policies. Those are bells and whistles you can add on at a lot of companies. This is not really that style of policy for banking. Okay, Kevin is asking you this question, Robert, or comment. I'm using my IBC policy to pay for a used boat. Using a combination of IBC with a projection plan to have it paid out by month 23. So I think you're saying you're taking a loan and you have 23-month payback you've came up with? If that is right, let us know, Kevin.
Is it better to pay off?
Is it better to pay off the IBC loans before or after the year closes?
Oh yeah, man. Yeah.
Good question. Good question. If we understand it, go ahead.
Great question. Great question. I would say it's better to pay it back beforehand. The reason being is because inside of your contract and how it works inside your banking system is when you pay loans back to yourself, not only do you keep all the money you pay back, but you actually can keep the interest that you pay back. So just like Jeremiah was talking about, he was able to pay in a bunch of extra funds into the policy on top of the annual contractual premium. That's nothing but extra funds that's going into the policy. So if you pay yourself back plus interest, you're growing the policy even larger. Exactly. Just like in Kevin, okay, it's in real time. Kevin saying, meaning the gains go to me. Exactly, Kevin. You keep all that with you. That's why I like using my policies for like investing and doing like day trading and stuff like that. Because if I can take out 1,000, turn it into 2,000, and have a place to put it back in and offset my capital gains and so on and so forth. That's what I use my policy for. So great question. Definitely, if you can, you definitely want to utilize it and do it, pay it back before the year ends.
Now, don't forget as well, I'm going to add something in extra that the insurance company is going to assess simple annual interest on what you have outstanding. So if you decide to pay it back, which we would generally suggest in most cases, depending on what type of investment or what type of deal you're doing, remember you're offsetting the simple annual interest charge to the insurance company. Don't worry, you still got compounded interest on every dollar you ever put in, so you're going to win, right? But you want to be conscious of money costing something. And when you borrow from the insurance company, they're going to tell you this is what it costs to utilize this money and to keep it out each and every year. But don't worry, even if you didn't pay it, crazy enough, your death benefit will cover it every time. They owe you money, not the other way around. Does that make sense? Okay, we got Linus out here today. Welcome back, Linus. Linus is part of our application team. He's with the Money Multiplier. Here's some of our contact info. Let me actually share that with you on the screen. But our partners, or maybe you can, maybe you're already doing it. Okay. So our partners over there at the Money Multiplier do a lot of our paperwork. You can tell that me and Robert, we love to talk. All right, we don't love all the paperwork, but Linus does. So
I think he
Linus
knows
is one
that
of our,
based on
yes.
our emails.
So
Linus knows that.
Linus is one of our team members who help get you processed. So some of you, I heard maybe Antonio is in the process, right? Our friends at the Money Multiplier do most of that paperwork and to get you through your application stage, all the questions the insurance company asks, and they got to ask because they have to guarantee this money. And then the underwriting, which could be your health, could be some of your quote-unquote background check. It's not the background check you're worried about, but insurance has to check on you a little bit too. Okay? All right, so that's what's going on. Ladies and gentlemen, you inside our Facebook group, our friends who are on Zoom see that as a link. Robert, are you really helping people? Are you really answering their questions about how to do this? And are you really doing it for free?
Yeah. So
All
I
right.
mean, yeah, man. What we do, I think any real education is free, and it pays out a lot more than the time that you invested into it. And so we're willing to, like what we're doing right now, right?
Yeah.
Nobody's hey, get on for an hour and a half, and we'll pay you some money, right? We're doing what we do because we want to educate people. We understand that this is a concept. It is not a cookie cutter mentality, and it's something that everybody has something a little bit different going on in their lives. Everybody has something that is special to them, and they have personal financial goals. So we want to be able to touch people and help people as much as possible, and share our own personal experiences. I know hearing Jay Du's experiences and him meeting up with me a lot and helping me out and stuff like that. That changed the outcome. I might only have one policy
Right.
pay. You
Right.
see what I'm saying?
But how many you working on now?
Well, now I have 5.
There we go.
So, but that's because somebody took the time to be like, man, here's how this actually works. And I learn new stuff all the time. So like infinite banking is exactly that. It really and truly is infinite.
Love it. Okay, ladies and gentlemen, we're going to cut and run, and hope you enjoyed this. Please do jump into our Facebook group. If you can find that link through our social channels, we would love for you to be in there as you keep learning and learning while you earn, right? Your dollar's always going up. So you learn and earn at the same time. It's a free Facebook group. We just started a new community. We want to have conversations in there. I did put stuff in there today, this afternoon, about my baby and his policy. And here's the thing. The original projected dividend was $4. There's going to be 4 extra cash value dollars in the policy. Robert, you declare it right now.
Gotcha.
How many dividends do you think they're going to pay me? Did you see that last slide? I had a question mark. I don't know what the dividends are going to be.
The $400 extra dollars, right?
Now, no. I'm talking about the original.
Yeah. So it was
$1,200. They said,
and it was
is it
$6,650.
Yeah. So
okay.
$465 were available in cash value. They said, hey, we're projecting a dividend of $4 extra, $469 instead of $465.
I think it'll be more like maybe based on everything you've done, man. It might be like close to $100.
Okay. All right. Put your guess in that Facebook thread. Put your guess. What do you think that is? That I'm eager to learn, and I was trying to look up today. They didn't tell me yet. So anyway, when they give me the dividends for my baby's policy, originally it was going to be 4. You already know that I put in 400 extra individual upfront. Then we ended up, instead of 1,200 going in, 6,550 went in. Jump into the Facebook group, throw in the chat. I'll put it in later as soon as I figured out what was the actual dividend they gave. The bonus on top of the growth. Ladies and gentlemen, we out. We out. Mom, come get us. We're done. Peace, everybody.